Okay, so on this particular trade, you can hear me, right?
Yes.
Okay, good. So on the weekly time frame, the overall direction of the market is to the upside, and I've already dropped. Let me delete this. And I've already plotted my key levels. Can see there was a touch here, and that touch here, also here too. So that's it. So if I wanted to draw the Fibonacci 2, I will start from this low. This was the last lower high on a higher time frame. So, and this was the low that caused this big move before this retracement. So I will draw it from this low in an uptrend. I will draw it from this low, then drag it to the upside to the wick of the candle that caused the retracement. As you can see, when price got here, it started to retrace. So you will draw it at the top of that wick before the retracement. So you will draw it, and as you can see, so this Fibonacci level is going to be acting as a support level, like I always said. So having the Fibonacci level with a support level intersecting at this region, so that gives the trade that gives me more confidence to enter the trade, because there is basically two support level around there. So this Fibonacci and also this support level as well. So the what the Fibonacci does is that it will let you know when a retracement is over. So let's say if the Fibonacci was somewhere around here, even though there was a support level here, I won't be entering the trade because price might still come back down and still come to this Fibonacci level. So, but since price is here already and price is getting a bounce from here, as you can see, this was a fake out this week of the candle. Price got here at a particular point but got rejected. So that's showing that there is more buying pressure coming to the market. So this Fibonacci level will be acting as a support level. And the Fibonacci level really works the best because I've been using it now, and it's really useful. I mean, so you can use it to spot a key level, a resistance, or a support level. Even if there was no level here, this Fibonacci can also be used to draw a key levels. Maybe you are finding it difficult to draw a support and resistance, and I will also get there too. So after seeing the Fibonacci playing out around here with this support level, then I will then scale down to the daily time frame and see how candlestick are reacting to the region. And as can see, so this Fibonacci zone is acting as a support, and in a downtrend it will be acting as a resistance. So if you wanted to draw it, you will start from the low that caused the big move, and you put it to the top of that retracement. Before the retracement happen, the wicks of the candle, you will put it there. So when price got there, and also maybe a area of support level, so then you'll be looking for candlestick confirmation to enter the trade. So that's how I got into this trade. I got in somewhere around here with candlestick confirmation. So let me show you another example on how to use Fibonacci to find support and resistance. Since you have already drawn it, on your chart, so I don't think it's necessary to show you how, but let me show you my first. You have your PC there, right?
My what?
Your PC, like your computer.
Yeah, yeah, yeah.
Okay, let me show you my set. Maybe mine is different from yours. Maybe, so if there was a setting you need to do, so you can check it. I will go through it now. Let me, so that it will be the same.
Oh, you're gonna fix up the settings of the Fibonacci?
Yeah, the setting, like I just want to see the one you show me on Telegram
Oh,
is good as well, but I just want to see maybe So maybe let me take a picture of it. Maybe I just send it to you so you can cross check it if it was the same thing.
Oh.
Maybe after the video, let me just take a picture of it. You are seeing it, right?
Yeah, I'm seeing it.
Okay, good.
I was just going to correct it on my side.
So the setting just need to set yours just like this. And as you can see, same thing happened here. When price was going, like when price was moving higher at this region, I already draw the Fibonacci. No, it's not going. Okay, okay, it does not touch here. This was the impulsive move and this was the retracement, but price didn't get here, so I'm not going to draw it. Let me go to the hour time frame and see. Okay, so on the monthly time frame, price is moving to the upside. So if I wanted to draw my Fibonacci, I will start. If I wanted to draw it from here, I will start from this low, this higher low that caused this impulsive move, as you can see, that caused this move. And after I see
Yes.
that price was unable to continue heading higher, so I will draw the Fibonacci like this, then I will put it like this at the top of the candle that caused the retracement. So if price was coming down, I'll be expecting price to come back down to this Fibonacci level to act as a support. And also, if I look to the left, there was a support level here. Let me draw it out. At the middle of the Fibonacci, as you can see, there was a support level there as well.
Yes.
So that's what I always said. If you are using Fibonacci, you'll be using it with support and resistance or supply and demand zones. So when price got there, you can't just use Fibonacci on its own without maybe a support and resistance. Though you can use it to identify when a reversal is over, when if a reversal was happening. So you can use it to know when it is over, but you cannot use it for a trade entry on its own. You need another confirmation. So after identifying this strong support level, it was a resistance level here, but it has turned support as long as price broke it. So it has turned support. So I will then be going down to the daily time frame to look for entry. Now let me go to the 4 hour. And if you are using Fibonacci, if you wanted to target like your take profit, if you are using Fibonacci, your take profit should be at the top of the week, like where you draw your Fibonacci from this week. So that's
Yes.
that's where the take profit will be. So you put your take profit there and candlestick confirmation like this. After this bullish and engulfing candlestick on 4 hour, or you can still enter here, but I would prefer here. Let's just use it for an example. So
But sometimes I cannot catch it that fast.
what do you say?
I said sometimes I don't catch the entry that fast. The
Okay,
enters from
you don't get
right
entry
here.
fast. Why? Like
No.
after analyzing
Because
it,
we
it's
still struggle with
I don't hear you.
no, I'm still struggling with the
Entry
candlestick.
with the candlestick. Okay,
Yeah, I still
okay,
may I read the book you sent me.
okay. You are still reading it.
Yeah,
Oh,
that candlestick, right? Before
yeah,
you read the
that.
bullish engulfing, that is what candlestick that is.
Okay, okay, okay.
That's
Okay, you know what? Like what you need to understand about candlesticks is not the name. What you need to understand about candlestick is the psychology behind it. Like, let me tell
mhm.
you, when price got to this support level, you see this, what we call the bullish and going candlestick is the candle that covers up the last candle. As you can see, this blue candle, it covers this red candle here. So this was a bullish. So what that bullish engulfing candle means is that more buyers are coming and they are taking control of the market. Like they are taking control. So the buyers are more, like they are more in like they are plenty, like they are more in the market than the sellers. So this is what it means, that this blue candlestick has already engulfed the sellers. So buyers are now in control. And same thing as here. As you can see, this was a small red candle before this huge candle form. So what that means is that buyers have already like get into the market and they are dominating. So that's what it simply means. Oh shit. Excuse me. Okay. So that's what you need to understand by candlestick is the psychology behind it, not the names. You don't really have to know the name, but as long as you are following, you are hearing me, right? Are you hearing me? Okay. So what I mean is, what you need to understand is the psychology behind candlestick, not network. Okay, you are back. So you can hear me, right?
Yes.
Okay. So what I'm saying is that what all you just need to understand is the psychology behind candlestick, not the names. So when the most used candlestick is this engulfing candlestick, and what it simply means is that more buyers are in the market than the seller. So that's why this candle is bigger than this red candle. And same thing here as well. This bullish candle is bigger than this small red candle. So it just simply means that buyers are more than the sellers in the market. So that's when we'll
Okay.
be entering the trade. So it's just like the bigger the candlestick, the the more effective it is. So that's why I always use it. When price go to that area, I will use it for entry. So I will enter the trade here. And my stop loss will go. My stop loss will be like this, and take profit at the area. And this so that's how the trade would be using Fibonacci. So let me still use that. Let me still set another example on that. Okay. So in an uptrend, it simply means that you'll be waiting for price to create a higher high. Then if the lower high was about to be created, that's when you withdraw the Fibonacci. So this was an higher high. This one is an higher low right here. Let me delete this. So price was moving to the upside right here. So you would have already drawn the Fibonacci like this. Let me wait. Okay. So you will draw it like this. You withdraw the Fibonacci when you see that price is coming down in an option like this after drawing it from this low. So you withdraw it to this top when you see that these red candlesticks are forming. So you withdraw it to the point and you will wait for price to come into it so that the Fibonacci will be acting as a support level. So as you can see, there was a support level at the left as well. So there was a support level here too. So that's it. If you are using Fibonacci, if you are using this level of Fibonacci, it will always you will be always you'll be finding a support level at the area. So you are just going to be using it for entry. Let me so this how it's going to be. So I draw it from the swing low, to the swing high. So this was the low, and after you see these red candlesticks forming, when you see that okay price is coming down, then that's when you draw the Fibonacci. And already after you see that okay this was the area of the Fibonacci in this zone, in this 50 and 61.8%, that's the area that you find if there is support or a resistance level inside that zone. So as long as you have already find the zone, you will just wait for price to get into the zone and then move higher. So that's how it is. So on the let me go to the, and like I said, for the take profit, it's going to be at this top where the retracement happen. That's where the take profit is going to be, like this. So let me go to the 4 hour to look for entry.
The Fibonacci should draw on the higher time frame too.
Yes, the Fibonacci should be drawn on higher time frame so that you will see the movement of the market. If you draw it on the 4 hour time frame, like you can just draw it from maybe a small retracement and you might think that it was a big one, price might not even respect it. So that's why you need to be drawing your Fibonacci on higher time frame so that you clearly see where price is going, so you will know where to draw it from. So you can be drawing it on maybe weekly or a daily time frame. So after identifying an area where price is going to go, and after drawing your support level at that area using the Fibonacci zone, so you will just be waiting for price to come back to it on a lower time frame like the 4 hour for you to enter the trade. So when price got here, price start forming all these small bullish candlestick, but you cannot still enter it because this candlestick are still small. So you can only enter after seeing this bullish candlestick. As you can see, it's more bigger than these red candlesticks. So that signifies that more buyers are in the market than sellers. So that's just it. That's what they call bullish engulfing candlestick. It just signifies that so the candlestick is more better, is more bigger than the previous one. So that's it, and it's more bigger than this doji, this small one, and this red candle. So it engulf, as you can see, it cover up this three candle. So that's why it is an engulfing candlesticks. So and it was the most used one. Even you will still find it in the candlestick bible, but and you will still find the other ones as well, but the engulfing bar is the most used one, and it is the one like you will be using for trade entries, and because it's the most reliable one. So and as you can see, oh shit, this trade would have hit a loss somewhere around there. As you can see, it was heading, let me draw it properly. So it will have hit a loss and then it start heading higher. So what happened here is just a market manipulation. As you can see, price come to this area, take the stop and then start heading higher. So this is just basically a market manipulation. A lot of people would have get stock out around here, but that's normal in trading. So but what I'm just trying to say is that the Fibonacci really works. Like as you can see, price would have move higher and hit the take profit if this manipulation didn't happen. As you can see, price still hits the TP, but it has already
Take a
got a
longer time.
manipulation. Yeah. So and okay, let me show you this. Maybe if price was coming down at a resistance level, if price broke a resistance level and then go back up, like start trading above it back, we need to wait for price to retrace back to that area to confirm that okay, the area is still valid. Because if price breaks it and start heading higher, price might still come back down and still break it lower and start heading lower. But you need to wait for price to break after price broke it like this. So price will need to close above it and then retrace before you can still start finding a entry, a trading opportunity at that area. So you can still enter a trade. Yeah, let me you can still enter the trade somewhere around there. This was an inverse head and shoulder, as you can see. This was the left shoulder head and the right shoulder. Do you know what those patterns? Like the double top, head and shoulder, inverse head and shoulder.
Yeah, yeah, I can identify a double top and a double bottom,
Yeah.
but I don't know, I can't identify head and shoulder
Okay,
much on my own.
okay. This was an inverse head and shoulder. What it means is that for you to identify it, price will come to maybe a price will come to a support level, bounce off it, and then break the level. So what happened here is what they call market manipulation. Like the banks, they took stop loss of the retail traders. As you can see, a lot of people would have hit stop loss around there and then push price up. So in that in our in that scenario, we wait for price to go touch this resistance level. After this zone form, we would have already drawn this this rectangle. So when price come back to this zone, you will wait for price to break this resistance level. As you can see, it has turned resistance. This is the first touch and this is the second touch. So you will wait for price to break it. After price break it, you then can then find your entry somewhere around here. So this this inverse head and shoulder pattern, if it form at a support level like this, is a very good sign, because it signifies that okay, after this market manipulation has been done, so price will move higher significantly. So that's why a lot of people use it, because after a market manipulation happen like this, there is a high chance that price will move higher in that direction. So you can enter the trade right here after the break of the neckline. This is the neckline of the inverse head and shoulder, and your
Yeah,
stop
okay.
loss, yeah, that's the neckline. So your stop loss will go below here and your take profit will still be that area. Your take profit will still be this area. There's nothing that's going to change, but though, yes, but when price got to this area, let me go down to, okay, when price got here, you would have already identified this zone. When- as you can see, this is the first touch and this is the second touch. So you would have already moved your stop loss to break even, or even take partial profit if the market goes to this black line. So you have already take partial profits or move your stop loss to break even. So that's it. So let me still see if I still can find another Fibonacci level on the chart. So the inverse head and shoulder, same thing goes to the uptrend as well. If price was in
Some
an
of them must have
uptrend,
money. Sorry, yeah.
okay. So if price was in an uptrend, price price will break a resistance. No, price will touch it, got rejected from it little bit, and then break it. So after price broke it, price will now still come back down to retest that level and then start going to that in that direction. So after price broke a certain level and then come back down to be trading below it or above it, so there is a very high chance that price will move in that direction significantly, because there was enough liquidity in the market. A lot of people would have lose money to that break. So after that happen, there is a high chance that price will move in that direction significantly. So that's why it's good to know how to identify an inverse head and shoulder. And as you can see, this was, let me show you something here. This was a double bottom. You see, price came here, got higher, and then formed the. So this was a double bottom. So when you find the double bottom as well, you wait for price to break it and then retest before looking for buying opportunity. So same goes to uh, head and shoulder and inverse head and shoulder as well. But if it was head and shoulder, it will have to break a zone and then come back to the zone to retest it before heading higher. So that's the difference between double bottom, double top, and head and shoulder. So they are just a reversal pattern. So if you can identify maybe a head and shoulder or inverse head and shoulder at a support level or at a resistance level, so it will be good. So we just need to combine it with candlestick confirmation. So and that will still give you enough confidence to enter the trade after having maybe your Fibonacci, your trend line, and also at your support level. And if you can still have a reversal pattern like the inverse head and shoulder and the candlestick confirmation, so that will still give you enough confidence to enter the trade. So that's how it works. Let me show you one example of Fibonacci. Okay, good. So so this is what I was saying. When so for you to identify, like for you to identify a Fibonacci retracement earlier, for you to identify it earlier, as you can see, price was moving higher with this bullish candlestick. And then, but as far as you see that okay, price is now coming down, forming all this red candle, so you will bring out the Fibonacci 2 from this bottom to the top of that retracement. So after putting it like this, we then wait for price to come back down to it. Then we'll be looking for candlestick for confirmation. So the Fibonacci retracement is very easy if you can master it, and it's very useful because it will help you to know when the retracement is over in the market. So if you can really master how to use it, it's very good. So you just need to wait after an impulsive move. You will just need to wait for price to retrace back to the Fibonacci. So this is going to be another higher low in price. So if price got here and start forming bullish candlestick, it will be an higher low. So you will look for buying opportunity here, and your first take profit will be this resistance level, and your overall target will be this at the top when the retracement happens. And also,
No.
if this 27 Fibonacci level this was an extension level, so what it means is that you can still be using this level to find maybe a support or a resistance. It can also be used, and it can be used for maybe a you can use it for your take profit as well, because price will always get there. It might take time, but price will always get to the 27%, my this 27% Fibonacci level as well. But to be more realistic, that's why I said you should just be taking your profit at this top. But most people take their profit at this 27% Fibonacci level. But in a more realistic way, it will be better to take your profits at this top where the retracements happen. So that so now basically I'm just waiting for this trade to come back down to this Fibonacci level and start heading higher. And there was another example here. Let me show you. Okay, good. Let me delete this first.
You're recording it, right?
Yes, I'm recording it. Okay,
Mm.
so let me delete this. Okay, okay. So price was moving higher at this region. So this was the impulsive move. And when I see that price has now start forming all these red candles, so I then drag my Fibonacci 2 from this low from this touch of the trend line, from this low to the high,
Mm-hmm.
when the retracement starts happening. So now I'm expecting price to come into this zone. Then I'll be looking for buying opportunity. And there was a support level as well, as you can see. So that's what I always said. If you are finding your Fibonacci level, there will always be a support or a resistance level. If it was an unknown
What
trend,
if, what
okay,
if price go below? What if price go below
yeah,
the 61%, the 60% mark? What would you do?
yes. If price go below it like this, that means the Fibonacci is no longer used for that trade. You have to delete it. If price go below it like this, then it's no longer useful. But if price go below it and then it turns out to be a week, price can go below it and then it will later be a week after that candle close. So if that happens, then the Fibonacci is still valid to use. But if price close below it, like maybe somewhere around there, then the Fibonacci is no longer useful on that trade. So you just have to delete it. But so for now, as you can see, there was a touch here. So this was a strong resistance level, a strong key level, I mean. So now I'm just going to wait for price to reach to get to this region. Then I'll be looking for candlestick for confirmation. So the Fibonacci will just let you know when retracement is over, and also it will still be acting as a support or a resistance, and you can still be using it to find your key levels. Let's say you did not identify the levels, or maybe you are confusing either to draw it. Sometimes you might be confusing like either to draw your key level from here or from here or from here. But since you have this Fibonacci at this zone, so it's clearly that the support level is going to be here, because this was an this Fibonacci area itself, it was a support level, and having it to intersect with this support level make the trade a very solid one. Like, so that's how Fibonacci works. You just need to know how to draw it properly. So if price was moving higher like this on higher time, if price was going up, you just have to wait for a retracement. After you start seeing the retracement, then you will draw it from the top of the candle. For so you have to draw it to the top
From
of
the
the
bottom.
wick. Yes, the wick of the candle. So you just have to draw it, and then if price go there, you will start looking for candlestick for confirmation. So it just help you to identify that okay, a reversal is over. So now this is going to be this is an higher low. No, okay, this was an higher low, higher high. So if price got here and got rejected, this will be another higher low. So that's how it is. And then your take profit level is going to be at the top here. So that's it about Fibonacci. Let me see if I can find a Fibonacci for a downward trend, for a downtrend market. Okay, I found one. So you can see this move. This was a clearly downtrend. So let's say price was forming around here. You start seeing all this bullish candlestick. You will draw your Fibonacci from this top to this low, where where the where the retracement is happening. As you can see, when price got here, price starts retracing. So after you see all this bullish candlestick, after you see that okay, price is going to the upside, then you draw your Fibonacci from this swing high at this top to this swing low that caused the retracement. So you will now be waiting for price to tank to get into the Fibonacci level and the support level. Okay, good. So this is what I'm saying. You see that when price go to this region, though price respects the Fibonacci level and still held lower, but it was not like this when price go into a resistance level as well. As you can see, price touch it here, go, like price touch it, head lower, and price still touch it at this region and still head lower. But it was different here when price touch it and also touch a resistance level. The drop was massive, as you can see. There was so when you are using Fibonacci, you need to use it. with a support and resistance level. You cannot use it on its own. Fibonacci, though Fibonacci is very powerful, it's very useful and powerful, but you cannot use it on its own. You just have to use it with a support and resistance. So that way it will be more valid. So as you can see, price got to the Fibonacci level and got rejected. So your entry will be around here. Your entry will be here after. And the reason why I will be entering the trade at that region is because of the bearish engulfing candlestick that start forming. That so that means that more sellers are in the market. So okay, good. So what that means that more sellers are coming to the market. As you can see, price starts creating red candlestick. So after this candle close on 4 hour, then you enter the trade, and you enter the trade after this candle close on 4 hour time frame, and you can put your stop loss above this level or just above this support level, but it will be safer to put it above this level. So you can put it above the level and target this zone, this next major support level. So that's how it is. That's how to use a Fibonacci on a on trending market, and you can always use it when price is trending. You can't use it in a ranging market. And that same thing is happening here too. Let me delete this. So I was expecting price to continue heading lower, but price can't just be moving in one direction. Price need to retrace before creating an impulse leg. Price need to create a correction move before an impulse leg. So I think that's what is happening here right now. I was expecting price to head lower, but that's not happening. So when I draw the Fibonacci level after seeing that price is finding it difficult to head lower, so I will draw the Fibonacci like this. So then when price got to this Fibonacci zone and I find out that there was a support level. Let me draw it from here. As can inside the Fibonacci level, there was a support level here, there was a touch here, a bounce off here, and also a touch here as well. So I already know that there was a key level here as well. So now what I'm waiting for is price to break. Hold on a sec. Okay, I'm waiting for price to break this zone, like to break it to the upside, to come and retest this Fibonacci area and this resistance area. So that's what I'm waiting for. If price can get to the area, then I'll be looking for selling opportunity. So do you have any question on that, like on the Fibonacci?
No.
Okay, good.
No.
But you are getting it right.
Yeah.
Okay, good. So if you can really make use of the Fibonacci on higher time frame, you will also see changes in your trading. You will see an improvement, because so that's basically how to use the Fibonacci. And
I will just watch back the video when you send it to me.
What do you say?
I said I will just watch back the video.
Okay, good. So that's it on how to use Fibonacci to draw key levels, how to use Fibonacci to identify key level, and also how to use it for a trade entry. So maybe I will just end the call now.
Okay. And
You know,